My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make some money. My job's not just to entertain, but to educate and teach you. So call me 1-800-743-CNBC or tweet me at Jim Cramer. Was today's pullback all about profit taking? Or was it the real economy rearing its increasingly ugly head? Every day that the averages go down, the Dow slipped 102 points, S&P shed 0.78%, NASDAQ lost 0.97%. We have to ask ourselves the same question. Is the market finally responding to the fact that we have Great Depression-style unemployment, 38 million jobless claims in the last 9 weeks? Or is this just another garden variety sell-off in wake of a major rally? I'll give you a hint. It's not the real economy driving the bus. Look, I know the market's incredible rebound over the past 2 months seems totally out of sync with what's happening in the rest of the country. Wall Street's become divorced from Main Street, and we're told that's unsustainable. The thing is, I'm not so sure. This morning on Squawk on the Street, I kicked this idea around with David Faber and Carl Quintanilla. David was incredulous that I thought that perhaps we're just seeing a garden variety sell-off, not some reckoning with the reality of mass unemployment. I mean, how the heck could the market shrug off still another 2.4 million people filing for jobless benefits this very week? Remember, we get those claims Thursday morning. Let's start with the positives that help stem the bleeding today and I'd say almost all week, because that's the case. First, there was the news that Treasury Secretary Mnuchin told an online summit that we'll probably need another stimulus package on top of the $2.2 trillion Congress already appropriated. Hey, guys, that's huge. It tells you the White House is paying attention. They're not tone deaf to what's happening in this country. Now, we know House Speaker Nancy Pelosi's been trying to pass another multi-trillion-dollar bailout, came on the show to talk about it. But the Republicans in the Senate didn't even make her a counteroffer. If the president's pushing for relief, though, that could change. Pelosi won't get her full wish list, but she'll work with Secretary Mnuchin, and she's going to get something done. Or he's going to get something done, depending about your outlook. The impact. Well, geez, if you know that several $1 trillion of stimulus could be coming over the summer, that suggests the future will be brighter than the past. Sure, the economy looks bad now. Got to believe it looks better with a second gigantic relief package. Second, the Federal Reserve, which controls the printing presses, has been injecting money into the financial system at a furious pace, actually untold, and I'd say the fastest ever. In the last 2 months, we've seen more expansion of the money supply than we got in the first 5 years after the Great Recession started. You hear me? More. 2 months. When you hear that the stock market's only roaring because the Fed is propping it up, well, this explosion in the money supply is what people are talking about. Personally, I don't see the problem here. Extraordinary times call for extraordinary measures, and this is extraordinary time. As long as the Fed's going full throttle and rates stay low, the stock market's going to be a terrific place to be, even in a weak economy. Sorry. Let me put it this way. Any company that can maintain or even increase its dividend right now is a much better buy than leaving your money in cash or bonds. Like it or not, stocks are the only game in town. You've heard that phrase before. I'm sorry, I got to use it again. It's cliche, but it works. Crazy thing. $4 trillion have been pulled out of this market since the pandemic got rolling. And I think we're seeing some major pent-up demand. Just like people who are desperate to be for an end to the shelter-in-place order so they can get a haircut, this money on the sidelines that came out, the $4 trillion, it's itching to get back to work because it's making you nothing on the sidelines. Third, the vaccine. The silver bullet that lets us go back to normal. All week, we've been dealing with reports about a potential vaccine for COVID. The picture's getting clearer. A few days ago, Moderna released some very preliminary data from a very small size sample with no control that suggested their vaccine could be effective. That seemed very exciting until the next day, when the company announced plans to sell $1.3 billion worth of stock, right as a biotech journal questioned the significance of Moderna's data. The truth is, Moderna's vaccine is in phase 1 trials. It's being tested for safety, not whether it works. I think management's suffering from a disease that often afflicts young companies. It's called premature explanation. It's painful. If they'd simply told us the vaccine was safe and left it at that, it would have been better. We'll find out if it works in phase 2. Maybe they get a worse price on the stock offering if they had done it my way, but nobody would feel burned. Controversy aside, though, the fact that we spent all week talking about other vaccine possibilities absolutely cuts in favor of the stock market, because it reminds people that eventually we could get a vaccine. Notice I still said could, not will, and life can go back to normal. Fourth positive, lots of people, including many governors and a few money managers, seem to believe that the virus has been contained. Some even think it was never a big deal to begin with, although that largely seems like a function of geography. If you're living in a region that's mostly unscathed, I can understand feeling this way. Maybe you think the whole thing's been blown out of proportion. I know there's whole news channels that seem to think that way. A lot of people felt that the way that way in New York, though. Remember, that's the way we felt at the beginning of March. Rude awakening. Now, I really hope the rest of the country can avoid that harrowing experience, and I don't want it to happen, but it happened to us. Don't want it to happen to you. What matters here is that lots of Americans seem to believe we're nearing the tail end of this pandemic. And when we reopen the economy, life is going to go back to normal. This is a view that says we're about to return to the ski, well, we're going to do everything. We're going to go to the beach. We're going to take a cruise if they let us. Not to mention getting our hair cut, getting our nails done, working out at the gym, and maybe even hitting a packed bar, right? Get a couple of, anyway. I think that's too optimistic, but you need to know that this cohort exists. Hey, look, I own a bar. You think I don't want that to happen? Hello? Anyway, so with all these positives, why was the market still down today? Is it the jobless claims? No, I don't think so. I think the averages aren't telling us the truth. Stocks that managed to rally today were recovery plays: retail, housing, some really bad retailers, decent housing, travel, industrial, cruise, plane. They're totally in sync with the bull thesis I just laid out. Down and out mall retail was the strongest part of today, for heaven's sake. The weakest performers were actually the stay-at-home stocks like Take-Two Interactive, the video game company we'll hear from later in the show. Essential retailers got slammed. Hey, we're going to talk to Target later. In short, there's nothing in today's action. This is just Wall Street is worried about the economy. It's anything the opposite. They're just trying to figure out where stocks should be priced. So why did the averages go down? Simple. The stocks that got hit are the international techs, the companies that thrive on global commerce. They do a lot of business in China, and President Trump's once again ratcheting up tensions with the Chinese, this time attacking his formerly great friend, President Xi. The personal nature of his tweet attacks feels like an escalation. When the White House gets ad hominem, that means companies that do lots of business with China need to get ready for a world of hurt. Wall Street doesn't like ad hominem. And that's why the big international tech stocks let us lower today. Had nothing to do with the horrific labor market here in the U.S. Wall Street is still very much divorced from Main Street. They're not getting together anytime soon. It's kind of like, they've already moved into separate houses. They filed the papers. They got maybe a lot of information there. Bottom line, the market may have been hit, but today's action was still pretty upbeat about the U.S. economy. The decline in the averages came from the White House, once again getting tough on China, which is why I think we should hold off on another trade war until the economy's in better shape. But I understand, I do not think the Chinese have done inexcusable things here. As for the pain on Maine, it's left mainly on the plane, not on Wall Street. Got it? I think you've got it. Devin in Texas. Devin.
Hey, Jim. Thank you for taking my call and everything you do for us listeners. I have a quick shout out to my buddy Oscar in Tennessee who's watching this. My question is about a company that I have held for some time now, Baidu. After their recent earnings beat and just recently heard that they're delisting from the NASDAQ, I was wondering if this is a stock to hold for the long term.
Look, I went over the quarter. The quarter was a great quarter. But the problem is that I'm only recommending, remember, Alibaba. Baidu has real look like American financials. I only want to do Alibaba. Why? Because the tensions are so high here. I don't want to wake up and have the president say that, look, we should short all the Chinese stocks. Hey, really? Don't put it past him. Let's go to Amit in New Jersey. Amit.
Hey, hi, Jim. Can you hear me?
Yeah, man. Good to talk to you again. What's going on?
Thank you so much for the great work you and your staff and everybody does for us, people like us at home. Question for you is what is, I have 2% of portfolio value which I want to invest, Macy's or Ford. Macy's has got Q1 loss of about $1 million and $2 or $3 million was a previous year profit about the same time. So which one would see the light at the end of the tunnel?
Take Ford off the table. Now, Macy's, very good report out from Matthew Boss, my favorite analyst in retail, J.P. Morgan. Question, maybe we're going to be having a trough here. Look, I'm a guy who believes in owning TJX, all right? I want to own all the stuff. I want to own a store that gets all the stuff that the other guys are basically dumping and then marks them up. TJX, very good quarter today. Stock up big, owned by my charitable trust. I need to speak to Brandon in New York. Brandon.
Jim, booyah.
Booyah, Brandon.
Fan.
What's going on?
Hey, so my question's about Lamar stock and what your thoughts are for holding long term. Do you think that it can go back to
long term, their advertising is going away. I want very much to recommend the stock of Facebook for people who want advertising because they're also supporting small business and they've got hundreds of thousands of them. And believe me, while they're helping them for free, it's going to be a major game changer in earnings once these companies get their sites rolling. I know the averages decline, but the action was still upbeat about the economy, the future economy. Remember, the pain on Main is not on Wall Street. On Mad Money tonight, with millions of people largely stuck indoors amid the COVID-19 pandemic, video games are more popular than ever. So why is a stock like Take-Two declining today? Hey, let's talk to the CEO. Then I've got the exclusive with the CEO of Target. Find out how the retailer really fared in the first quarter. Forget the way the stock's acting. And Palo Alto just reported at the close. I'm crunching the numbers with the CEO. They look darn good fresh off the report. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.